Unit 4 Fundamentals of Investing and Financing the Purchase of Real Estate. Nowadays, buying real estate is more than just finding a home. The practice of investing in real estate has become increasingly popular over the last years and is now a common investment medium. The real estate market offers vast opportunities for making big profits. However, buying real estate is usually much more complicated than investing in stocks or bonds. There are 4 main real estate types. 1. Residential real estate. This includes both new construction and resale homes. The most common category is single-family homes. There are also condominiums, co-ops, townhouses, duplexes, triple-deckers, quadplex, high-value homes and vacation homes. 2. Commercial real estate includes shopping centers and strip malls, medical and educational buildings, hotels and offices. Apartment buildings are often considered commercial, even though they are used for residences. That's because they are owned to produce profits income. 3. Industrial real estate includes manufacturing buildings and property, as well as warehouses. The constructions can be used for research, production, storage and distribution of goods. Some buildings that distribute goods are considered commercial real estate. The classification is important because the zoning, construction and sales are handled differently. 4. Land includes vacant land, operating farms and ranches. The subcategories within vacant land include undeveloped, early development or reuse, subdivision and site assembly. There are various ways and instruments of real estate financing, governmental sources, commercial sources and other. An investor or a builder can obtain financial aid from savings and loan associations, banks, mortgage bankers and brokers, life insurance companies, credit unions, governmental agencies, savings and loan associations. The most important objective of these institutions is to offer mortgage loans on residential property. These organizations are known as savings associations, building and loan associations, and cooperative banks and are the primary source of financial assistance to prospective real estate investors. Some of the most important characteristics of a savings and loan association are: it is usually a locally owned and privately managed home financing institution. It receives individuals' savings and uses these funds to make long-term amortized loans to home purchasers. It offers loans for the construction, purchase, repair, or refinancing of houses. Commercial banks. Commercial banks are quite active in real estate financing. In acquiring mortgages on real estate, these institutions usually follow 2 main practices. 1. Some banks maintain active and well-organized departments whose primary function is to compete actively for real estate loans. In areas lacking specialized real estate financial institutions, these banks become the source for residential and farm mortgage loans. 2. Banks acquire mortgages by directly purchasing them from mortgage bankers or dealers. Mortgage and mortgage bankers and brokers. A mortgage is a legal document pledging property as security for the payment of a loan. It gives the lender the right to sell the borrower's property and use the money collected to pay off the debt if the borrower defaults on the loan. Mortgage bankers are companies or individuals that offer mortgage loans, sell them to other investors, and may act as agencies to dispense funds for taxes and insurance. Usually, mortgage brokers present real estate investors with loans from a variety of sources. Their income is generated from the lender making the loan, just like a bank. Because they can draw from a variety of lenders, they can achieve the best available terms. Notwithstanding legislation that could favor big banks, mortgage bankers and brokers keep the market competitive so that the largest lenders must continue to compete on price and service. Life insurance companies. Another source of financial assistance is life insurance companies. These companies finance real estate as a form of investment and adjust their portfolios accordingly to reflect changing economic conditions. Individuals soliciting a loan from an insurance company may deal directly with their local branch office or with a local real estate agent who represents an insurance company. Credit unions. These cooperative financial institutions are created by people who share a common bond, for example, employees of a company, labor union, or religious group. Some credit unions offer home loans in addition to other financial services. Real estate investment trusts. A real estate investment trust, REIT, is formed when a company, or trust, uses investors' funds to purchase and manage income properties. REITs are purchased and sold on the major exchanges just like any other stock. Other sources. Individual investors constitute a significant but slightly declining source of money for real estate mortgage loans. Researchers claim that these lenders prefer shorter-term obligations and normally restrict their loans to less than 2/3 of the value of the real property. There are various ways of investing in real estate. There are many people that would love to invest in real estate, but they either lack the whole amount of cash for down payments or they think that buying and owning are the only ways to make money in the real estate market. This isn't necessarily true. Below there is a list with different ways to invest in the real estate market. 1. Leasing. This is an investment that is as old as the practice of land ownership. In this practice, a person will buy a property and rent it out to a tenant. The owner is responsible for paying the mortgage, taxes and costs of maintaining the property. Upfront, buying a real estate to lease it out may cost the same money when purchasing to flip a property, but the return will be slower. One thing to consider, however, is the long-term potential. If you are purchasing real property in an up-and-coming area, leasing it out might be the smarter move since value could increase substantially as the area improves. Thus, it will still be a significant long-term investment, depending on the tax write-offs and potential future sales. 2. Flipping real estate. To earn profits from flipping real estate, you can either buy low and sell high, this is more successful in a rapidly rising market, or buy a home that needs repair and fix it up before reselling it for a profit, fix and flip. For flipping, it is important for the property needs to be substantially undervalued at the point of purchase or remodeled to increase the value enough to turn a profit. 3. Real estate investment group. Real estate investment groups are similar with small mutual funds for investing in real estate. If the investor wants to own a rental property but doesn't want the responsibilities of being a landlord, the real estate investment group may be the solution. A company buys or builds a set of apartments or condos, and then allows investors to buy them through the company. The investor can own one or multiple units of the property, but the company is the one operating the investment group and collectively manages everything: maintenance, vacancy, advertising, etc. In exchange for this management, the company takes a percentage of the profits. 4. Real estate investment trust. As mentioned previously, a real estate investment trust, REIT, is formed when a company, or trust, uses investors' funds to purchase and manage income properties. REITs are purchased and sold on the major exchanges just like any other stock. Insurance is a system under which the insurer, for a consideration usually agreed upon in advance, promises to reimburse the insured or to render services to the insured in the event that certain accidental occurrences result in losses during a given period. Green, 2017. It is a method of handling risk. Credit insurance. The use of credit nowadays is so frequent and widespread that there exist many types of insurance to cover some of the risks involved. Examples of these risks are listed in the next part of the unit. The purchase of credit insurance is on a voluntary basis, but it is a valuable asset for someone investing in real estate. Mortgage insurance. Another instrument of real estate security is the mortgage insurance. It is an insurance plan that protects the lender if the borrower does not repay a loan. It gives the lender the right to sell the borrower's property and use the money collected to pay off the debt if the borrower defaults on the loan. The main risks when investing in real estate are the following. 1. Sponsor risk. The experience and capacity of the developer, operator or lender can have a substantive impact on whether the sponsor can execute a business plan and deliver targeted outcomes to the stakeholders. 2. Liquidity risk. One of the main drawbacks of investing in real estate since there might be relative difficulty in converting an asset into cash and cash into an asset. 3. Foreclosure risk, attaching to home loan debts when installments are not paid for various reasons, resulting in foreclosure with a subsequent loss to the creditor. 4. Risk of loss, from export credit because of war, currency restrictions, cancellation of import licenses, or other political causes. Loss of savings from bank failure. 5. Physical assets risk, unexpected costs may potentially arise due to the condition of the property itself. 6. Construction risk, every time a project involves significant construction, new development, redevelopment of an existing asset, there are risks that the construction project may incur cost overruns, take longer than anticipated to complete, or expose previously concealed deficiencies in the physical asset. 7. Leasing risk, where a current vacancy exists in a real estate asset that the sponsor expects to lease up over time, there is the risk that the lease-up may not occur at all or may occur at a slower rate than the sponsor anticipates. 8. Cap rate risk, prevailing cap rates for different asset types move in ranges and are subject to supply and demand for that specific asset type. A minor movement in the cap rate percentage can have a substantial effect on the residual value of an asset and, in turn, the profitability, or loss, of a particular transaction. Before purchasing real estate property, investors or their consultants always need to research the area and determine the average market value of area homes. For example, community factors such as amenities, quality of schools are vital when evaluating real estate. Also, it is important to detect and mitigate all potential risks related to the investment, as real estate ownership comes with a lot of risks. 1. Detect risks. Detect and identify the various types of risk involved in the investment. 2. Assess the potential risks. Understand and assess the various types of risk involved in the investment. 3. Evaluate. Evaluate the risks and decide on control measures. 4. Manage risks. 3 basic strategies for managing risk: avoid the risk, limit acceptable risks, transfer risk.